Good afternoon, friends. In the subject of fundamental of investment, in my previous lecture, I talked about derivatives market, in which I talked about what is meaning of the derivative, what are the characteristics of the derivative, and what are the different types of derivatives. This we discussed. Now I'll be talking about participant in the derivative market. If you recollect, what we mean by derivative is, it's a financial instrument which takes place through a contract between the two parties and the value of which depends on the value of some underlying assets. Broadly, there are two types of derivatives. Contract means financial assets derivatives, commodity derivatives. When I talk of the financial assets derivatives, what we mean the stock derivatives, index derivatives, the currency derivatives, the exchange rate derivatives, interest derivatives. When we talk of the commodity derivatives, we are talking of agri-commodities, we are talking of the gold, silver, metals means oil, right? So these are the different types of the assets and the real assets or real estate, even there may be real estate assets, right? Of these derivatives markets are prevalent. So who are the parties who are involved in the derivative markets? I will say there are three different type of parties which are involved in the derivative markets. So in the derivative market, different type of parties participate. The three category of traders in derivative markets are called hedgers, speculators, and arbitrageurs. So let me talk of what the hedging means, who are the hedgers, who are the speculators, who are the arbitrageurs, right? Let me talk of the hedgers first. See, traders are exposed to continuous risk that price of assets they are holding may change over time. They use financial derivatives like futures and options to hedge the price risk. For example, in case of a commodity future contract, farmers want to lock in the price for their produce and the merchant wants to lock in the price they would pay for their produce in advance. What it means is, hedging means that the change of the price, if there is a substantial, what you want to do is, you want to minimize your risk by making a contract so that your risk is being minimized. What you do is that you are making a contract at a particular price so that your risk is being minimized. As in my previous lecture, I will repeat that type of example, that supposing I am an importer. I want to import from America. For importing from America, I'll have to pay in terms of dollars. I am making a contract with an exporter of America. That is, for me, it's an import. For the businessman in America, it is an export, right? Of say $1 million worth of trade that will take place. And the present rate is say 75 rupees per dollar. Means the transaction is worth 75 million rupees. For me, the worth is 75 million rupees, and for him, the transaction is worth $1 million. I, as an importer, will have to pay in terms of dollars. This is our agreement. And if supposing the Indian currency, that is rupee, depreciates and the value of the dollar appreciates, because what I have rupees, I don't have dollar, I have rupees, and then this rupee will be converted into dollar and then the payment will be made. So at today's price, my transaction is worth 75 million rupees, right? Supposing the value of rupee depreciates, and that is the value of dollar appreciates at the time of the receipt of my commodities, of which I have made the agreement with the American exporter, right? I'll have to pay, say, after 3 months, right? And at the time of the receipt of my transaction, means my goods, I'll have to pay after 3 months the $1 million. So I'll have to pay rupees which is equivalent to the $1 million. And supposing at that point of time the value of rupee depreciates and the value of dollar appreciates, and after 3 months the value of rupee will, or the value of dollar will become equivalent to 80 rupees. It means at the time of payment I'll have to pay 80 million rupees. So what I can do is I'll make an hedging, that is, if today the price is 75 rupees per dollar, so I'll buy $1 million at the rate of in the future market. I'll buy the dollar at, say, for example, 76 rupees in future market, because people are expecting, like me, other people are also expecting. So after 3 months the future price is at present 76 rupees per dollar. So what I'll do is I'll pay 76 million rupees and I'll make a contract. Right? Supposing after 3 months at the time of payment, the value of dollar becomes equivalent to 74 rupees. It means there is a risk that I will have to I had paid 2 million rupees extra. But if it becomes equivalent to 80 rupees, it means my risk has been hedged and I'll be saving this 76, 80 minus 76, 4, I'll be saving 4 million rupees. What I've done is I've hedged my risk. That is, my risk is to the extent of 76 rupees, that is the value of dollar is equivalent to 76 rupees. So in this way, even if at the time of payment the dollar becomes equivalent to 1890 rupees, my risk is not there, because I have already made a transaction, I have already made a derivative contract in the future, right, that after 3 months I'll be getting the dollar at the rate of rupees 76, that is, I'll be getting that each dollar at the rate of rupees 76. So my transaction is worth $1 million. So I'll have to pay only 76 million rupees, right? So in this way, what I've done is I've hedged my risk. So hedgers are the people who minimizes the risk, right? So traders are exposed to continuous risk, because there is a continuous risk. The value of the currency keeps on fluctuating, the exchange rate keeps on fluctuating. So what I've done is I've hedged against this fluctuations in the value of rupee and dollar prices, right? This exchange rate, I would say. So traders are exposed to the continuous risk that the prices of assets they are holding may change over time. I hope you have understood, because had I not made a derivative contract at the time of the delivery, if supposing the dollar becomes equivalent to 85 rupees, that at that point of time, after 3 months, I'll have to pay $85 million. Present rate is 75 only, right? I'll have to pay 85 million rupees, right? So there will be a lot of fluctuation. What I've done is I've made a contract today at the rate of rupees 76, right? So whatever the price at the time of the payment of the dollar and rupee, whatever the exchange rate may be, right? My risk is minimized. I have hedged against that risk. So these are the people called hedgers. So they use financial derivatives like futures and options to hedge the price risk. Like in the commodity also, it so happens that is in advance you make a contract. Say, like example, in case of the commodities, in case of the farmers, right? So I know that I'll be getting 1000 kg of, say, rice. So what I'll do is that I presume that the price of rice may fall when the harvest will be ready. So what I'll do, I'll make a contract with a trader who deals in the rice at a particular price, 1000 kg of rice which I am expecting to get from my farm. I'll make a contract with the trader that at the time of the harvest, I'll be giving you 1000 kg of rice at this very price. So what I've done is, even if the price fluctuates, even if the price reduced, say I've made a contract that I'll be selling the rice at the rate of rupees 75 or at the rate of rupees 70 per kg. So 1000 kg of rice I'll be giving at the rate of rupees 75. So at the time of the delivery, I'll have to give at the 75. Even if the price becomes 70 rupees or it becomes 85 rupees, I'll be giving at the rate of 75 or whatever the rate it has been decided by between the farmer and the trader. So right. So this way in the commodity market, in the exchange rate market, the risk is being hedged. The other party is called speculators. Speculators are the people who want to make quick gains, right? And they presume a long or short position. You take a long or short position depending on their expectation about the future. So speculators enter into the market with an objective to earn profit by assuming long or short position, right? I am expecting that price of this share will go up. So what I'll do in the derivative market, that is in future market, in future, I'll buy the current at the current price of a particular stock. Say I'm bullish in A stock. So what I'll do is I'll buy this A stock at the current price, and since I'm expecting that in future the price of A stock will go up, so in the derivative market, that is in future market, I'll buy this stock of a quantity, say 1 lakh share, 10,000 share, 20,000 share at a particular price. And if price goes up, I'll be the gainer because I have purchased at the current price. And if there is a 10% appreciation, so say expiry is for 1 month, after 1 month. So I make a future contract that I'll buy this A company share at say 2,000 rupees. And after the month, at the time of the expiry, suppose the share becomes 2,100 rupees. So because I have purchased, already made a contract in the future market at the current price, I'll be a gainer. But if the price falls, if it becomes say 1,800, I'll be a loser because at the time of this, I'll have to settle the contract. When the expiry period will come, I'll have to settle the contract. So speculators are the people who want to make quick gain, right? They take a call. They take a call of either the market will go up or the derivatives contract which we are making. It may be commodity, it may be financial instrument. If I talk of the stocks, means I am expecting that share price will go up, right? So I make a future contract at a current price. If I presume, we call it short position. Short position are people who feel that market will come down, price will come down, the share price will come down. What I'll do, I'll sell the share at the current price without even having the share. I'll say 10,000 shares I will sell at the current price. If the price of that share did not fall, I mean it does not fall when the expiry periods comes, then I'll be a loser, right? So but if it falls because I am expecting, I'll be a gainer, right? Because I have purchased, I have sold at the current price, and at the time of the expiry of the contract, the price has already come down, so I'll be a gainer, right? So depending on the short position means those who are expecting that market will fall, they take short position. Those who takes that market will increase, market means the share price will increase, they take a long position, right? So these are the participants who are ready to take a risk for some additional return. So they are the major players in the derivative markets providing liquidity to it. So speculators, I mean a large number of derivative contracts takes place by speculators. The other type of the players in the derivative market is called arbitrageurs. See, arbitrageurs are the people, the firms, the companies which want to take advantage of the difference in the price in the two markets, right? Say for example, there are two markets in India for the stocks, that is the stock exchange I am talking of, the BSE and the NSE. There is one price in the BSE market, and of the same company's share, the price in the NSE market is little bit different than the prices of the BSE market. So what I'll do is, I'll buy in the one market and I'll sell in the other market and make the profit by the difference in the two market. Say for example, in the BSE market, in the BSE stock exchange, the share price of a particular company is traded at 100 rupees. And in the NSE market, at the same point of time, the share of that company is traded at 100 rupees 50 paisa. So what I'll do is, I'll buy from the BSE at 100 rupees and I'll sell in the NSE at 100 rupees 50 paisa. So thereby, I'll make a profit of 50 paisa on each share, because these arbitrageurs deals in volumes, large volumes. So 50 paisa apparently looks to be a small amount, but if I buy 1 lakh, 2 lakh, 5 lakh shares, right, and sell from the one market, I buy 5 lakh shares and sell immediately in the second in the other market, that is the NSE. I buy from BSE, sell in the NSE, right? So I'll get a good profit. But providedly there is a difference. So means there are times that when there is a difference in the two markets, so arbitrageurs buy in one market and sell in the other market the same asset, right, and thereby make the profit. So are those traders who make advantage of any discrepancy between the prices in the two different markets. They take buy position in one market and sell positions in another market and earn profit due to difference in these prices. So underlying reasons for this market is inefficiency. Means normally no market is perfect. So because of these market inefficiencies, there may be or there are price differences in different markets. So these arbitrageurs take advantage of this, and because of that they make profit. So I have taken an example which I have already explained. So if the price of the stock is BSE is 100 and the price in the same stock in NSE is 101, means I was talking of 100 rupees 50 paisa, here I have written 101 rupees. So arbitrager can make profit by purchasing share in the BSE and selling the same in the NSE. Through it involves transaction cost, which is very small. Means in the difference of the 1 rupee, and the transaction cost has to be paid by the buyer and the seller, right? The same person is a buyer and same person is a seller. So the transaction cost, the 1 rupee difference minus transaction cost, will be the profit of the arbitrageurs. So hedgers, speculators, arbitrageurs. So hedgers use derivatives to reduce the risk that they face from potential future movement in the future market. As I said, in the hedgers takes a advanced position to make the contract of the difference in the prices. That is, hedgers take an advanced position and they tries to minimize the risk. Speculators use derivatives to be on the future direction of the future market. Speculators are the people who take position, means they think market will go up, so they buy at the current price and makes profit by selling at a time when the price will go up. There are people who feel that the price will come down, so they buy at the current price, and if the price comes down, they make profit out of it, right? If it doesn't, they will be the losers. So speculators speculate about the future price conditions in the market and thereby tries to make the profit. Means they make a derivative contract and tries to make profit out of it. Arbitrageurs take offsetting position in two or more instruments to lock in a profit. Means they buy in one market, sell in another market and makes profit. So these are the three type of players in the derivative market: hedgers, speculators and arbitrageurs. Now let us talk of the different types of derivative instruments. Means if I talk of the financial derivatives, broadly there are three. I have not talked about swaps. I am sticking to these three: forward, future, options, right? So these are the different types of financial derivatives. I am not discussing swaps. Let me talk of forward first. A forward contract is these are the different type of contract that takes place in the derivative market. That is forward, futures and options. These are very important to understand for you. What is forward derivative? A forward contract is an agreement between the two parties to buy or sell of an asset or for cash at a future date at an agreed price today, right? I was saying that you determine in advance that I'll buy dollar at rupees 76. What are you doing? You are making a forward contract that after 3 months the dollar will be purchased of this much quantity. Say in my example I took $1 million at rate of 76. So means the two parties are making an agreement to buy and sell an asset. Asset in our case is dollar and dollar, right? So buy in dollar with exchange of the rupee at a particular price. So a forward contract is an agreement between two parties to buy and sell an asset for cash at a future date at an agreed price today. In forward contract, date, rate and quantity all are decided at the contract date. Means today itself, I am making the contract today. Today itself what will be decided when the contract will expire, that is when the transactions will be offsetted, what will be the rate at which it will be offsetted, a specified rate, what will be the rate, and quantity, what will be the quantity. In case of agri commodity, I said 1000 kg of rice after say 3 months when the harvest will be rated. So we have date is decided that after 3 months from today, this much price. If I say the rice forward contract, so 1000 kg of rice at say 70 rupees, if the contract is at 70 rupees per kg, right? The date is after 3 months and the quantity is 1000 kg rice. So a forward contract, the date, rate and quantity all are decided at the contract date. I am presuming the contract is today. So at the time of contract itself, the date, rate and quantity is being decided. But the contract is implemented in future on the agreed date. Date we have already decided after 3 months. So agreed date is from today. After 3 months, the transaction will be settled, right? So date, rate and quantity all are decided at the contract date, but the contract is implemented in the future on the agreed date, right? These are tailor-made contract dealt over the counter market. Forward contracts are tailor-made. What do you mean by tailor-made is that it depends on the requirement of the two parties, the buyer and the seller. Unlike in the future market which are exchange traded, I'll be talking of that, which are exchange traded, the standardized quantity is being fixed by the exchanges. Of that standardized quantity, you can make as many contract as you want. Say if I am saying each contract is of 1000 kg of rice. So if I want to make a one contract, right? If I want to sell and buy 1000 kg of rice, one contract. If I want to sell 2000, two contract. But I cannot make a contract if the exchange has determined 1000 kg of rice of each contract. I cannot make a contract of 800 or 900 kg, right? Either it will be 1000, it will be 2000 in the multiple of 1000 kgs. But here in the forward contract, they are tailor-made, means as per the suitability of the two parties, the parties which are involved in the contract. So these are tailor-made contract dealt over the counter market. Means over the counter means these are the private contract between the two parties. These contracts are obligatory for either of the party. Like the Contract Act is implemented in India, so like the similar Contract Act means the contracts are obligatory as per the Contract Act of India. These contracts are obligatory. But there is no third party which is giving the guarantee. Like in case of the exchanges, when the derivative or when the derivatives takes place through exchanges, so it is the responsibility of the exchanges to get it implemented. Now it is the obligation of the exchange to get it implemented. But since it is the over the counter contract, so exchanges are not involved. It is the agreement, like the simple agreement between the two parties. The similar manner, this is the contract to the boundaries. If one of the party fails to fulfill the contract, the other party has all the right to go to the approach to the court of law or the agency through which it can get the contract implemented, right? So these are basic contract between the two parties. So these contracts are obligatory for either party. They are means to hedge the risk, right? I have already spoken about it. Both the parties suffer the risk of default by another party. Increased prices move in unfavorable direction, because in case there is an unfavorable direction, means I have sold the rice, a farmer has sold the rice at 70 rupees to a trader. But supposing at the time when the harvest becomes ready after say 3 months, the price of rice, because of the shortage of rice in the market or high demand in the international market, whatever the reasons may be, price shoots up to 100 rupees kg of that quality of rice. Farmers may, if it is a greedy farmer, he may not like to give this much rice to the trader at this price. Then it means the farmer is in default, and the the trader has the risk that if the farmer does not give the rice to the trader, then the contract, it is difficult for him, when only he will have to go to the court of law for getting this contract implemented. Similarly, if the price comes down from 70 rupees, the contract is at 70 rupees. If the price comes to 50 rupees, 45 rupees, 60 rupees, any price less than 70 rupees, the traders may not like to take it. If it defaults, then again the farmers will have no other choice but to approach to the court of law. Means there is a default risk. In case the derivatives takes place through exchanges, there is no default risk because it becomes the responsibility of the exchanges. So in India, the forward contracts have been quite common in agriculture produce. By and large, for agriculture produce, the forward contracts takes place. Examples, let me take some examples of forward contracts. Suppose a farmer wants to sell wheat. I have taken the example of rice earlier, similar example I have written here, I am giving you. Suppose a farmer wants to sell wheat at the current rate of rupees 28 of say 5000 kg, but he knows that wheat prices will fall in the coming months ahead. So in this case, he entered into a contract with the grocery, means the trader, for selling them at a particular amount of wheat at 28 rupees of 5000 quantity in 3 months. So what the farmer has done is that at a particular price of a particular quantity at a particular date, the farmer has come into an agreement, entered into an agreement with the trader, right? So this is called the forward contract, where the rate is fixed, that is in our example 28 rupees, quantity is fixed. I have not shown here quantity, but I am mentioning you 5000 kg of wheat or rice, whatever it is, right, at after 3 months, right. So the time is fixed, the date is fixed, the rate is fixed, and the quantity is fixed. Now, if the price of wheat falls to rupees 26, from 28 it has fallen to 26 rupees at the time of expiry of the contract, then the farmer is protected, because farmer will get the price at the rate of 28. For 5000 kg, he will get the price of 28 rupees. The trader cannot say that the current price is 26 rupees, so I will be paying at the rate of rupees 26 only, because the derivative contract has taken place already in the forward market and the price is being fixed at the rate of rupees 28. So the trader will have to pay at the rate of rupees 28 for 5000 kg of the wheat, right. But if the price of wheat rises, then also the farmer will get the price mentioned in the contract, that is 28 only. If the price goes up, if from 28 becomes 32, right, so then also the farmer will have to deliver its harvest of 5000 kg of wheat at the rate of 28. So this is example of forward contract. Forward contract is very much prevalent in India, especially in the agri commodities. The forward contract is very much prevalent. So what we have discussed in this lecture is the forward contracts. I will be talking future and options in my next lecture. So I have talked about what we mean by forward contract. We talked about the 3 different parties which are involved in the derivative contracts: the hedgers, the speculators, and the arbitrageurs. Thank you very much.